Great tax changes for 2024 coming down the pike. This is good stuff. This is good stuff. So let's check this out, my friend. Inflation causes IRS to raise tax brackets and standard deduction by 5.4% for 2024. Adjustments for key numbers for income, gift, and estate taxes give taxpayers some planning opportunities. 100%. So let's check out what old Ashleah Belling. Let's see what she has to say. Here's an upside of persistent inflation. More of your income will be taxed at a lower rates. Absolutely. This means some Americans will pay less in taxes, according to some professor. The adjustments based on formulas set out in the tax code are meant to keep inflation from hiking taxes. Yep. The standard deduction and for each tax bracket will be up 5.4%. That's fantastic. The second largest adjustment in the last 30 years after last year's 7.1% hike. You know what's not getting adjusted for inflation? Social Security taxation, because that's still from 1983 numbers. Such a freaking clown show. All right, so the threshold for the top bracket will climb by nearly $40,000 for a married couple. That's the top bracket. We don't care about that. Your effective tax rate will be lower than your top rate. That's because the first slice of income is always taxed at 10%. Actually, a first slice of income is taxed at 0% because of standard deductions. There's no personal exemption. That'll come back in 2026. So the first slice of your income is taxed at 0. The next slice is 10. The next slice is 12%, so on. Your effective tax rate is essentially a blended tax rate. Yep. All right, knowing the tax bracket of your marginal, so right here, a married couple with $300,000 of income taking the standard deduction would have a marginal tax rate of 24%. Yep. They would have more than $100,000 left before they jump to the next highest rate at 32%. So they might start considering converting a part of their money to Roth. Maybe. I'm a big fan, but here's the effective tax rate right here. All right, so this is for single taxpayers. So basically, is this your taxable income? This is going to be your taxable income. So for a single, the first $11,600 will be subject to 10% tax. This is taxable income after the standard deductions already come down. And the standard deductions can be roughly $14,000 for single people, or roughly $28,000 for married people. And again, I don't know the exact, it'll probably be in here. But anyway, after a standard deduction, you have $11,600 that's subject to 10% tax. The next roughly $37,000 will be subject to 12%. And then anything above that will be subject to 22%, all right? I hate to say anything above that, but anything from $47,000 to $100,000. And again, married filing jointly, your first $23,000 after the standard deduction is subject to 10%. The next, $70,000, $71,000 is subject to 12%. Anything over 94% will be subject to 22%. So you got a lot of wiggle room right there, man, between 94 and 201 before the next high tax bracket. Let me just stop real quick, though. A lot of people get really caught up like, I don't want to go in the next high tax bracket. Dude, it's 2% difference. It's just it. You could say it's a 10% difference. I get you. But it's literally jumping from 22 to 24. Not a huge jump right there. So if you're $5,000 into the next top bracket, it's just, who cares? The big jump is from 12 to 22 and from 24 to 32, really. So that's kind of what you want to avoid. You want to avoid going into the 22% tax bracket if you can, and you want to go avoid into the 32% tax bracket if you can, because that's where the big jumps are. Let's see if they say what the standard deductions are. Yeah, standard deduction right here. Standard deduction for individuals, $14,600. Right on, man. That was much higher than I thought, which is up from $13,850. Oh, great. Standard deduction for married couple is $29,200. We'll take it, baby. So here if we go back to single people, I'm just going to use $14,000 because my caveman head, I can figure this out. So we got $25,000 of income that will only be subject to 10% tax. All right. Now, only, and of that 10% will only be taxed on $11,000. The first $14,000 isn't subject to anything. All right, the next $10,000 is subject to 10%. So if you had $25,000 of income, you're only going to pay $1,160 on your income tax on $25,000 of income for a single person. Does that make sense? I hope so, because again, the first $14,000 is not taxed because of standard deduction. The next $11,000 will be taxed at 10%. All right, so we literally, to be in the 10% tax bracket, you would need plus $14,000, about $61,000. No, that's the 12%. Excuse me. To To be in the 12% tax bracket, your gross income would have to be less than $61,000 for a single taxpayer. It's pretty good, man. 61,000 schmackaroonies, and you're still in the 12% tax bracket. And that's not an effective tax because remember, the first 14,000 isn't subject to any tax. The next 11,000 is subject to 10%, and the rest, about 37,000, is subject to 12. That's pretty good. So we'll take the wins when you can get them, baby. All right. So capital gains, right? Oh, even better. The income threshold for paying capital gains at 0. Some taxpayers might want to sell appreciate stock when they can snag a 0% capital gain right here to be in the 12% tax bracket. Again, they're talking taxable income. I'm talking standard deduction. So taxable income and gross income are different here. So for gross income for married people, you'd be roughly 94,000 plus 29. What is that? This is 125. So you can have $125,000 of gross income and still be subject to 0% capital gain. Now, as always, I tell people, you can't just sell $500,000 worth of capital gain stock and still be in the 0% tax bracket on the capital gain. It doesn't work like that. I'm just trust me on that. People think I can sell $500,000 and have no capital gain tax. No, because that will put you above that. But let's just say you have $80,000 of income and you say, I'm going to sell $30,000 of capital gain, no capital gain tax. Take the time. Take advantage while you can, dude. I'm telling you right now. So look at that, dude. Right there. 94,000 is your taxable income. You had roughly 30,000 for standard deduction. That's 125,000 of gross income where you can have 0 capital gain tax. And qualified dividend too, by the way. And if you're single, it's about 61,000 before you have 0 capital gain tax. That's pretty fantastic. So here we go. You're single. You make $75,000 gross. You got $14,000 of standard deduction. Your taxable income is $60,000. Your marginal rate is $22,000, but your effective tax rate is only $13,000. You pay $8,341 on $75,000 of income. So if you actually look, $8,341. So we go 8,341 divided by 75,000, 750,000. Your effective tax rate is actually 11% because they're saying your effective tax rate is on all of your taxable income. That's stupid, man. Right Capital does the same thing. That's not the way it should be. Your effective tax rate is your tax rate that you pay, your total tax on all of your income. So in this case, while you're in a 22% marginal tax rate, your effective tax rate is only 11%. That's a big deal, dude. That's a big deal for sure. The state tax, where is it going here? $13.6 million for a state tax, and what's the gift tax? $18,000 annual exclusion, and your lifetime exemption is what here? Let's see the lifetime exemption. Federal gift estate tax is $13.6 million one per person, and again, those are portable. So if you don't use it, your wife can use your 13.61 plus her own would be $27 million. I don't have that kind of scratch. You don't have that kind of scratch. Annual exclusion now is $18,000 free, and then you have I can't remember what the lifetime exclusion on gift tax is. They don't see it on here. Let's see, estate tax exemption. I don't see any lifetime exclusion on gift tax. I think it's like $5 million. IRA 401k contributions are now up to $500. All right, so it's $23,000. All right, that's pretty good. So that's good stuff, man. So I want to show you guys something else. So people are, what's a big deal? Until 1981, the income tax brackets were not indexed for inflation. Huge tax hikes hit people in the 1970s because from 1970 to 1980, huge inflation, which meant your income was being taxed at a higher and higher margin because the index was not adjusted, the tax rates weren't adjusted for inflation. That's in my opinion, that's one of the biggest. Not only did Reagan cut the rates, the top rate for I think it was 50, 70, something like that, to 24, something, I can't remember. But I mean, we can look at it, but I just don't feel like it. But he cut the rate significantly, got rid of a lot of deductions, all that stuff, I grant you. But most importantly, he indexed the tax rates for inflation. All right, so if you think about it, if they did not do that, if you're making $25,000 now as a single taxpayer, you're probably in the 35% tax bracket if they did not index the tax rates for inflation. That's the exact same thing with Social Security. They did not index the Social Security for inflation, taxation for inflation. Such a scam. And Obama tried to do that same thing with Irma as well. Think about if you were still under Irma from Obama in 2009 or something like that. And now we're 15 years later. How much more income you're making now in 2023 compared to 2009 if they did not subject the Irma amounts for inflation? It's crazy, dude. And they're never going to come back to it because the Social Security makes so much money on taxation of Social Security benefits. So the way you do it to avoid that is you start doing Roth conversions, you stop deferring money, all that stuff. You live off your capital gains, long-term capital gains, you live off your qualified dividends, you live off your Social Security, and you live off your Roth. That's what I'm doing. Now, some of you guys might be, like I'm talking to a guy today, he's only 48. Him and his wife are just freaking crushers. Literally, they're taking financial planning and crushing it. They don't need me. They're kicking ass and taking names. But he's got so much money in his TSP. I said, dude, we'll call him Smarty Pants. I said, Smarty Pants, you got to stop doing that. Put it all into the Roth, dude. All in the Roth. He goes, but I'm in a decent tax bracket. I said, no, but and I showed him the RMDs later on in the future. It's like, oof. Let's at least minimize that to some regard. And when he retires at 57, he's 58, 59 or something like that, he'll be living off his retirement accounts before he takes Social Security when he's 67. So he's going to have 10 years of distributing money from his retirement accounts. And that's the way to do it for sure. Anyway, just think how grateful you should be that they index the tax codes for inflation, the tax rates for inflation. Look at that. The ERTA, Economic Recovery Tax Act of 81, slashed the highest tax rate from 70 to 50. And there's 19, when they slashed it from right here, 86, I think they dropped 28. That's what it was. They slashed the highest tax rate from 70 to 50, and they indexed the brackets for inflation. It's the TRA, the Tax Reform Act, where they got rid of all those deductions and whatnot, where they slapped a two-tier tax, flat tax, 28, and I think the last was 10 or something like that. 28%. The 28% tax rate promise lasted until only 1988 when George H.W. Bush, that idiot, fell for George Mitchell's promises, snake oil promises from Maine to cut spending by $2 for every dollar of tax increases. And they never cut the spending, but they raised the taxes. What a friggin' idiot, dude. Anyway, look at that, dude. That's, this is right here. How the history of federal income tax. It's just... Let's take a look at the 1913 form right here. Someone sent me a copy of this in the mail a long time. When I first started my YouTube channel, it was fantastic. I loved it. It's not coming up. There we go. It was great. Look at this. It was simple. I got a copy of this. It's fantastic. Oops, let me get rid of here. Boink. There we go. Boink. Boink. Easy peasy. Easy peasy. Percent amount owed over 20,000, not exceeding 50,000. 20,000 in 1930. You were living large. Look at that. 20 to 50. If you didn't have $20,000 of income in 1913, you didn't pay any tax. How many people had $20,000 of income? Very, very few. So anyway, this is good news, man. Everyone's going to gripe about it. It's not. Let's see if they actually say anything in the comments about the annual. Let's just look it up. So I thought it wasn't unified. I guess maybe it is. The lifetime gift exemption is the same right now in 2023 as the estate tax exemption of about 13 million. So that's good. So I mean, you should stroke me a check right now for 13 million bucks. You don't pay tax on it. I don't pay tax on it. Now, if you're giving me appreciated stock, I'll have to pay tax on the sale of those stock because the cost basis that you paid transfers over to me. It's still a worthwhile cause. You should literally do that. Here's a check, Josh, for $13 million. You don't pay tax on it. I don't pay tax on it. Say thank you. And again, if you gift me stock that's appreciated value, I'll pay tax. I'll be happy. I'll be happy to take those capital gains off your hands. Just I'll let you know. I'll be doing you a favor. But anyway, take the W when you can. This is a big W. There's always stuff to complain about. But man, we're not Sweden for heaven's sake. We're not commies. We get to keep a hell of a lot more of our income than almost any other country in the world. That's just a fact, Jack. All right. These videos help you. Want to buy me a cup of coffee? It's the Doobie Duke. Don't forget to sign up for my email list, the Doobie Duke, and we'll see you later. Thanks now.